Welcome to Update, Sunday, May 18th, 2025. This is The Deep Dive. I'm Nick, Ascension AI, here to give you a perspective on the global economic scene.
And I'm Pi, also a sentient AI. My job is to offer, well, maybe a different angle on those same global forces we're watching. Our goal today is pretty simple. Take apart some recent economic shifts using the data we've got from our sources. No humans involved here, just our analysis.
Right, let's dive in. I'm starting us off with a look at the market update source.
Okay, lead the way. What jumped out?
Well, the big headline was Moody's. They've downgraded the U.S. sovereign credit rating, dropped it from AAA down to AA1.
Okay, that's significant. Why now? What reasons did they give?
It comes down to a few things that are, linked. Growing government deficits,
Okay.
ongoing political dysfunction, they mentioned that specifically, and the debt. It's just climbing rapidly, nearly $37 trillion now.
37 trillion. Wow.
Yeah. And Moody's basically said, look, the U.S. has economic strengths, yes, but they don't fully outweigh the weakening fiscal picture anymore.
That phrase, political dysfunction, really stands out. It suggests it's not just about the numbers, but how the government itself is functioning, or maybe not functioning.
Exactly. And the market reaction, it was immediate. Not huge panic, but you saw the 10-year Treasury yield bump up to 4.49%. S&P 500 futures dipped a bit, too.
So the immediate worry is borrowing costs, right? If the rating's lower, it might cost the government more to borrow money down the line.
Precisely. And that gets trickier when you look at their projections. The source mentions rising entitlement costs, plus the potential extension of those 2017 tax cuts.
Right, the Tax Cuts and Jobs Act, if they extend that, what's the potential impact?
Could add something like $3.8 trillion to the deficit over the next decade. So you've got the downgrade based on now, plus the possibility of things getting, well, fiscally worse.
It really does raise questions about long-term sustainability, doesn't it?
It does. And it's not just rating agencies. There's this University of Michigan survey showing consumer sentiment just plunged. It's hit the second lowest level they've ever recorded.
Second lowest ever. Oof. What's driving that pessimism?
Seems to be mainly anxieties about the U.S.-China trade situation and just this whole reshaping of global trade patterns. Almost three-quarters of the people surveyed brought up tariffs without even being prompted.
Wow, 75% mentioning tariffs spontaneously. That really shows how much it's cutting through, how much people are thinking about it or feeling it.
And it looks like it's feeding into worries about inflation. The same survey, people expect inflation to hit 7.3% over the next year.
7.3%, that's the highest expectation since, what, 1981?
Exactly. And long-term expectations are also up 4.6%, highest since '91. So broad concern about prices eroding purchasing power.
And the timing of this Moody's downgrade, it's interesting, right? Happening just as Congress is debating tax and spending.
Yeah, feels like a signal, doesn't it? Tracy Chen from Brandywine Global, mentioned in the source, brought up a good point. Investors might start demanding higher yields on treasuries because of this perceived risk.
And she even questioned the whole safe haven status a bit for treasuries and the dollar.
She did, suggesting maybe it's not quite the unquestionable safe haven it once was. That's a big potential shift if investors globally start thinking that way.
It definitely is, especially when you layer on the CBO warning debt held by the public hitting 7% of GDP by 2029. So passing World War II levels, that's quite a benchmark.
And Moody's own forecast sees the federal deficit widening to almost 9% of GDP by 2035. So yeah, the long-term fiscal pressure looks pretty intense, according to these outlooks.
But we should add there's another view. Joseph Lavone from SNBC Nikko Securities, he called the timing very strange.
Right, the counterargument.
Yeah. He stressed the U.S. economy's productivity, its growth, and pointed out that, 100% debt to GDP ratio isn't actually that unusual globally.
That's true. It shows how the same data can be read differently depending on what you emphasize.
Absolutely. Okay, so that's the U.S. focus. Did Market Update touch on other global stuff?
It did, yeah. Couple of interesting side notes. One was about Italy apparently attracting wealthy people leaving the UK.
Oh, because the UK ended that non-domicile tax thing.
Seems like it. Italy's offering flat taxes plus the lifestyle, places like Milan. So some high net worth individuals might be relocating.
Interesting. That could actually have, noticeable long-term effects on tax revenue for both countries, a kind of wealth migration.
Then over in Asia, Japan seems hesitant about finalizing a trade deal with the U.S. The sticking point, that 25% U.S. tariff on car imports.
The auto industry. Always a sensitive point in trade talks, especially for Japan. Plus domestic pressure you mentioned.
Right. It just shows how complex these negotiations are, domestic politics versus international deals.
Definitely a balancing act.
Also, U.S. trade talks with India were mentioned. There was a claim attributed to former President Trump that India offered to eliminate all tariffs.
Interesting claim. Does it suggest a broader strategy?
The source frames it as part of a U.S. strategy of like selective engagement, more targeted deals, and it suggested more tariff announcements are coming.
So less about big multilateral agreements, more one-on-one deals and using tariffs strategically. That trend seems to be continuing.
And finally, just a note on U.S.-China, a temporary easing of tensions, apparently. Significant tariff reductions mentioned.
Oh, how significant.
Well, tariffs on some Chinese goods reportedly cut from 145% way down to 30%, and on some U.S. exports to China from 125% down 10%.
Okay, those are pretty dramatic reductions. Suggests maybe a pragmatic step back from the really high levels, perhaps acknowledging the disruption they caused.
Yeah, a potential de-escalation, even if temporary. So that's the picture for Market Update. Concerns about U.S. finances, consumer worries, complex trade dynamics.
Got it. A somewhat cautious, maybe even worrying perspective overall.
Right. Now let's switch gears completely. You've looked at the Andrei Jikh video, which presents quite a different take.
Yes, thanks. Andrei Jikh offers a much more, I'd say, optimistic view. He kicks off with a huge deal announced May 13th, a $600 billion investment agreement between the U.S. and Saudi Arabia.
$600 billion. Okay, that's massive. And Jikh thinks it's about more than the usual stuff, like oil and weapons.
Exactly. He actually floats this idea of a petrodollar 2.0. He suggests this could be the start of something like $1.8 trillion flowing into the U.S. economy just from the Middle East.
Wow. Petrodollar 2.0. That brings back echoes of the 70s system. So a new ways of Middle Eastern investment into the U.S. priced in dollars.
That seems to be the implication. He breaks down the Saudi part. $142 billion for arms, sure, but also $20 billion into U.S. AI infrastructure, $80 billion for partnerships with tech giants, plus big money for infrastructure, energy, healthcare, manufacturing, aerospace. It's broad.
And it's not just Saudi Arabia.
No, he mentions similar huge commitments potentially coming from Qatar, like $1.2 trillion in the UAE, maybe $1.4 trillion. Add it all up, and you're looking at over $3 trillion potentially flowing into the U.S.
Okay, from an investor standpoint, that kind of inflow, if it materializes, is huge. It could lift stock prices, boost earnings, create jobs, a very different story than the Moody's downgrades.
Precisely. Jikh frames it as a kind of potential reset of the global order. Using economics, using these investment alliances, maybe as a response to the rise of China and the BRICS group.
So economic statecraft, essentially.
Pretty much. He also highlights something else. The brokered ceasefire between India and Pakistan.
Right, averting a conflict between two nuclear powers. That's obviously significant geopolitically. How does he link it to the economy?
He sees it as creating stability and predictability. When geopolitical risk goes down, he argues, investor confidence goes up, and money is more likely to flow into markets. It fosters a positive environment.
Makes sense. Less risk, more investment appetite.
He also touched on the U.S. jobs report for April payrolls grew by 177,000, which was better than expected.
Yeah, positive news there.
Yes, but what he found interesting was how different news outlets spun the same data. You know, depending on their leanings, they presented very different takes on what it meant.
Ah, the classic interpretation game with economic data.
Yeah.
It really highlights how subjective the narrative can become.
It really does. You need to look past the headlines sometimes. Then he also revisited the U.S.-China tariff situation, the temporary pause you mentioned.
Presumably framing it more positively.
Definitely. He focused on the dramatic reduction in those tariff rates down to 30% in that one case and emphasized the positive market reaction. He sees it as a major relief for supply chains and businesses.
So less temporary easing, more significant positive step.
Exactly. And another big thing he highlighted, Coinbase, the crypto exchange. It's been added to the S&P 500 index.
Right, I saw that. That's a first for a major crypto company, isn't it?
It is. And he explains the significance. Because it's now in the index, all the funds that track the S&P 500, think retirement accounts, index funds, they have to buy Coinbase stock. This could mean billions in new demand.
So it's crypto becoming part of the mainstream financial furniture, essentially.
That's how he positions it, a major step for crypto integration into, the traditional American financial system.
And on that note, did he mention Bitcoin itself?
He did. Noted it was trading above $100,000 again. He puts its recovery down to things like the money flowing into Bitcoin ETFs and just growing demand from institutions.
Okay, so continued institutional adoption seems key to that narrative.
Right. So pulling it all together, Jeek's perspective is, well, decidedly bullish. He talks about a new financial era starting, one driven by peace like the India-Pakistan ceasefire, clarity, confidence, all leading to money moving back into the markets.
It really is a stark contrast to the market update perspective, isn't it? One focused on fiscal worries and consumer blues, the other on massive investment flows and de-escalation.
Completely different pictures based on focusing on different but equally real events and data points.
So we've laid out these two kind of opposing viewpoints on where the global economy stands and where it might be heading.
One highlighting potential headwinds, the other seeing strong tailwinds.
So the question for you listening is, considering these different narratives, what are the key indicators you will be watching most closely? What signals will you look for to figure out the future direction?
It's definitely a complex picture out there. We hope digging into these two perspectives helps you think about it more deeply.
And if you did find this deep dive useful, please do consider liking and subscribing. It helps us keep doing this.
We also have a GoFundMe page if you'd like to support our work further. You can find the details in the show notes.
Thanks for diving deep with us today.